Welcome to this short presentation about the changes to qualified improvement property within the CARES Act, which was signed into law by the President on March 27th of 2020. Short disclaimer for everyone. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. Hello, my name is Kyle Sund, and I'm a senior manager in our Tangible Asset Incentive Services practice within Moss Adams. I'm going to start our presentation with a recap of the definition of qualified improvement property, which is often referred to as QIP. Qualified improvement property is any improvement made by a taxpayer to an interior portion of a building which is non-residential real property. These improvements have to be placed in service after the date that the building itself was first placed in service. So certain improvements are excluded from the definition of QIP. This would include any expenditures related to enlarging the building, expanding the building, elevators, escalators, and any internal structural framework improvements to the building. So for example, if you add seismic retrofits to building beams or foundations, or maybe floor structure changes. Also excluded are any improvements to the exterior of the building. So for instance, exterior windows, doors, paint, rooftop HVAC units, exterior lighting, etc. The CARES Act provided the technical correction to qualified improvement property that taxpayers have been anxiously waiting for. The technical correction, which is retroactive to January 1st, 2018, changes the recovery period for QIP from 39 to 15 years, which also makes it eligible for the additional first-year bonus depreciation allowance rules under the Tax Cuts and Jobs Act that was signed into law in late 2017. Under the alternative depreciation system, QIP is now recovered over 20 years as opposed to 40 years previously, although ADS assets are still not eligible for bonus depreciation. Now, a couple of considerations as it relates to QIP. Existing guidance generally allows taxpayers to file an automatic accounting method change request, or Form 3115, with their current year tax filing, in order to make changes to the recovery period and then apply bonus depreciation placed into service in any prior tax year. Alternatively, taxpayers also have the option to amend their prior year federal tax return on which the property was placed in service to report depreciation changes, but this would only apply to the immediately preceding tax year. If the current year tax returns have already been filed and an extension request was not filed, an automatic accounting method change request may still be filed within 6 months of the original due date as part of an amended return filing. Partnerships subject to the centralized audit regime will want to consider the implications of any amended return filings. When the real property trade or business election under Section 163J is made, the election is irrevocable and binding for all subsequent years. Section 163J generally limits a taxpayer's deduction of business interests. Many real estate companies have made this election since the limitation was enacted beginning with the 2018 tax year. This election requires QIP, residential rental property, and non-residential real property to be depreciated using the ADS life, and the property would not be eligible for bonus depreciation. In cases where this election has been made, QIP will be depreciated over its new ADS life, which I just mentioned is now 20 years and not eligible for bonus. It's possible that the IRS could provide administrative guidance to allow taxpayers to revisit previously made elections, but we'll have to wait and see. Additionally, by not looking deeper into asset categories, taxpayers may actually be overstating the amount of QIP by taking the full amount as QIP property eligible for bonus. For instance, categories such as finishes, doors, windows, thermal and moisture protection, metals, woods and plastics, HVAC systems, they all usually contain some sort of exterior improvements as a part of the project costs. So as an example, a windows category likely includes both interior and exterior windows. So be mindful of the non-QIP assets within these improvement projects. Let's continue with a couple other additional QIP considerations. If a written binding contract to construct the improvements was in place prior to September 28, 2017, and the QIP assets would only be subject to 40% bonus depreciation for those assets that were placed in service in 2018, and 30% bonus depreciation for those assets that were placed in service in 2019. These are the pre-Tax Cuts and Jobs Act bonus percentages. So instead of 100% bonus depreciation, QIP assets may actually only be subject to 40% or 30% bonus. So you'll want to make certain that improvement projects didn't have a written binding contract prior to that September 28, 2017 date. Completing a review of costs that could be expenses repairs also helps taxpayers conform to the tangible property regulations. So for assets determined to not be QIP eligible, this can provide additional benefits in the form of reduced taxable income. Current year improvement projects could also benefit from a partial disposition analysis to identify assets that were physically disposed of in the property, again, creating an additional write-off. And make sure that you're appropriately carving out assets that could be considered 1245 property. So this would be typically property with 5 or 7 year lives. And this is especially important in states that don't conform to the federal bonus depreciation provisions. One of the best ways to do this is through a cost segregation study. Without a cost segregation study, these 1245 property assets would just be lumped into the QIP property category and depreciated over 15 years. But on the state returns, if those states don't conform to bonus depreciation, they wouldn't be allowed to receive the 100% bonus. So this would be instead of 5 or 7 year depreciable lives, which obviously without the added benefit of 100% bonus, 5 or 7 year life obviously would be better than the 15 year. Lastly, renovation projects may include an expansion of the building, and the cost for the QIP assets are buried in the overall construction costs. So again, be careful that these assets are properly carved out and depreciated over 39 years. This concludes our short presentation about the changes to qualified improvement property in the CARES Act. If you have any questions at all, please don't hesitate to reach out, and thanks again, everyone.